This Fed Day, folks. Brian Wesbury with us from First Trust Advisors in Chicago. Brian, good noon to you.
Hey, good noon to you too, Tom.
Let's talk here. Ellen, can you bring up that committee, that single sentence from the statement? I don't know if we've got this graphic up here. Let's bring it up if we... No, we don't have it yet. Let me read it to you, Brian. The committee expects these effects to be transitory, but it will pay close attention to the evolution of inflation and inflation expectations. Right. How are we evolving in our inflation?
Yeah, I think we already have an inflation problem. I mean, the canary in the coal mine, so to speak, is the gold price, the oil price, the commodity prices, and the value of the dollar. They all show that we have too many dollars in the system, too much liquidity. But even core inflation is picking up. Over the last 3 months, it's up 2% at an annualized rate, and I think it's going to accelerate. By the way, Tom, I've gone back and read just about every economic report of the president, every word in the economic reports of the president back in the 1970s, and all during that 1970s period, the government, the Federal Reserve, and the Treasury kept saying inflation was transitory. It wasn't going to last, and we all know that that history now. Inflation ended up getting to 12%, and I'm afraid that we're repeating those same kinds of mistakes right now.
Brian, there's a lot to talk about. You and I could go for 2 hours here, but within this, and you have been one of the great optimists out there, bring up this elegant chart, if you would, Rex. I think this is really an interesting chart. We showed it a couple weeks ago. Corporations like QE2, everybody likes QE2. It's inflationary, we'll suggest. The white line is NEPA profits. The yellow line is a non-farm payroll growth. Brian, are you still suggesting that job growth will catch up with those corporate profits?
You know, I mean, I didn't see your chart. I caught it out of the corner of my eye. I'm not going to say job growth is going to spike like corporate profits have, but I do think we are going to continue to see 200,000 plus jobs a month throughout this year and into next year. One thing to remember, you know, everybody likes to say quantitative easing is what drove the stock market up. But in reality, your point is its profits went up. It's hard to imagine that QE2 can cause profits to go up. If it would have caused just stock prices to go up, we would have seen PE ratios go higher. But in this recovery, PE ratios have been flat to down, which tells me this is not just a sugar high. This is not just something being driven by easy money.
Julia Coronado with us, joining us from BNP Paribas, their chief North American economist as well. Julia, how much top-line animal spirit do you need to make this equation work for Chairman Bernanke? Do we need 4% or 5% top-line GDP?
Well, it's not just the top-line GDP, but how long we can sustain it. So we saw that, for example, in Q4, we got a decent top line, 3%, not great, but pretty good final demand composition. But we've already faded in Q1. So it's not just how strong, but how long. And I think we need a couple of years of what they would consider solidly above trend growth before we've really meaningfully eaten away at the slack. Now, that's not to say they can't take baby steps towards normalizing policy to some extent between now and then, but they're in no hurry. The U.S. economy isn't anywhere close to overheating.
Let's stay with that. Julia Coronado with us and Brian Wesbury. Here's Coronado of BNP Paribas. The bind that ties the Fed's hands. Ben Bernanke's going into the press conference handcuffed. The Fed has done what it can to support the domestic recovery, but it's rapidly reaching the point at which the cost of further stimulus would outweigh the benefits. Brian Wesbury, there's Dr. Coronado speaking. QE3 would be a little overdone. Would you suggest that to be the case?
Yes, I agree with that statement. In fact, I think they reached that point a while ago. One of the things about quantitative easing, and we could talk about this all day, is that right now the banking system, what they're saying is, hey, you can pump in all the money you want, but we're just going to hold it as excess reserves. We're not going to fall into the trap of lending this stuff out and then having you guys come back and trap us and call the money back. So what's happening is quantitative easing is taking place, but it's not turning into M1 or M2 money supply. What I'm worried about is the 0% interest rates. They're too low, and that's what's creating the inflationary pressures.
Dr. Coronado, if rates are too low, what's holding the Fed from going up to, say, 1%, or going up a quarter of a point, going up a half a point? What's the harm?
I think, again, the way the Fed is viewing this, and I would agree with this view, is that right now the upward pressures on inflation are not being driven by the U.S. economy. They're being driven by the global economy. And the U.S. consumer is being asked to absorb a pretty sizable inflation shock.
Yeah.
If you then, on top of that, raised interest rates, that would probably knock some steam out of the stock market at a time when house prices are already falling and confidence is pretty shaky. That's a pretty toxic mix for the U.S. economy to handle, and I think you only engage in that if your back is against the wall.
Julia, Brian Wesbury is optimistic. Bring up this chart. It's a break exclusive. Wesbury optimistic, and it's new home sales. Wait a minute. New home sales look terrible.
Terrible.
They look terrible. Brian, how can you be optimistic over new home sales?
Well, you know what? I'm not optimistic. They went up. They were above consensus, and that's what we pointed out in our piece.
Yes.
I think that might be what you're referring to, Tom. They went up. So did existing home sales. So did housing starts. So did pending home sales. So did housing permits. So that was against the grain of all these bears out there. But remember, housing is only 2.4% of GDP right now.
Now, Julia doesn't agree. Julia, help us out
disagree.
here.
I mean,
But hold on. Equipment and software spending is 8.3% of GDP.
Right.
So why don't we talk about that? It's
We do
booming.
talk about that.
Housing's going down.
Okay.
Equipment and software is going up.
Julia, last word to you. Rebut.
Okay, so the reason that we talk about housing still is that it is the biggest asset on the consumer balance sheet. So it matters. House prices matter to consumer confidence, to consumer spending, and that is 70% of the economy. So
and I don't mean to interrupt you there.
Excuse me, Brian.
But
Absolutely,
we all
the
know
corporate
that housing's
sector
really
is
important.
Okay, Brian.
But what I will tell you is that you can't buy a house unless you have a job, and unless you have income, and it's equipment and software that give you your income.
Right.
Sir.
That's how you buy a house.
What
So
we're gonna do-
what's more important, the house or the job?
Peter Bookvar said, Fed guns ablaze. So is Brian Wesbury. Let's give the last word to Dr. Coronado. Tell us your thoughts on what you heard from Brian.
Thank you, Mr. Keene. My only point that I was trying to make is certainly there are clearly strong spots to this economy and a more organic, stronger dynamic taking place. But there are still excesses that we are working off after years of over-leveraging. Those excesses happen to be concentrated in the household sector, which is still more than 2/3 of the economy. So settle in, folks. It's going to be a long ride.
Great. Julia, thank you so much.